Good afternoon. Thank you for joining today's Public Housing Repositioning Strategies for Small Public Housing Agencies webinar series. Together with presenter Mike Andrews, Principal of Structure Development, and myself, Christina Pan-Smith, are your hosts today. We also have subject matter experts from HUD on the line to answer your questions during the Q&A at the end of the session. Before Mike begins, I have a few housekeeping items. We have allotted approximately 2.5 hours for Mike to speak on the designated topic, and we'll leave 30 minutes at the end for a question and answer session with our subject matter experts. In that regard, if you have questions for the presenter throughout the presentation, feel free to ask questions in 2 ways. In the right-hand navigation panel, you will see a hand-shaped icon. If you'd like to verbally share your question, select the hand icon and I'll unmute your line in the order of questions received. Or if you'd like to send us your question, feel free to type your question in the chat box in the lower right-hand navigation panel. I will read your question aloud in the order received. If we're unable to address all questions, we'll send an email reply after the webinar. All webinar participants are muted upon entry. If you'd like to notify our team of any technical difficulties, please send us a message in the chat box. Today's webinar is being recorded and will be available on HUD Exchange shortly following the webinar. Immediately following the webinar, you will receive an invitation to complete a survey. On today's webinar, we welcome you to complete the short survey and share any ideas you may have for future webinars. I'll now hand it over to Mike to begin the presentation.
Thanks, Christina. Good morning or afternoon, everyone, depending upon where you are. This is the third in our series of 4 presentations about public housing repositioning, and thank you for joining us again today. Today we're going to talk about project-based vouchers, PBV, and what is sometimes called the decision tree, which is actually a couple of decision trees that we'll talk through as a way to help you think about how to evaluate your properties in the context of a repositioning and make a decision about the best option. This goes back to some of the stuff we talked about in the first session, where I described understanding your current state and taking a whole lot of things into consideration to then understand what you want your desired future state to be. So the decision tree or trees will be some tools to use to help you think about how do you get from your current state to your desired future state. A couple of ground rules again. We're asking folks to participate in each of the sessions. They do build on each other, and I think you'll find there's stuff in all of them that are helpful. Try to avoid distractions, so close emails, turn off any certain congressional hearings that might be going on, and we'll have an enjoyable couple of hours together. And then please do ask plenty of questions. There were several questions that were posed and sent following the last session. We're still working on getting those answers written up, and I'll have those sent back to the people that presented them. And today we're going to try to keep evaluating how we're doing here. Today we're going to try to let folks just raise their hand and ask the question directly. So we're thinking about how we can facilitate a little bit more participation, have folks engage a little bit. So rather than just reading the question, we'll unmute folks and let you ask your question directly. All right, so let's get in on it. So we are here at the third session, again, the intersection of project-based vouchers and the decision tree. We've previously talked about an introduction to repositioning, RAD, Section 18, and streamlined voluntary conversion. Our last session is this coming Thursday, the 21st. We're going to start with a knowledge check, and we revised how we're doing this one a little bit, so we're not going to do the poll. We're just going to present the question and as a way to kind of refresh some of the things that we talked about in prior sessions, and I'll flash the answers in the subsequent slide. So some of the reasons that a housing authority may choose to reposition: stabilize revenue, provide access to capital, either debt or equity, and reduce the administrative burden. True or false? RAD is the only repositioning tool that allows a housing authority to carry over existing public housing funds or reserves and use them towards a replacement reserve to support future Section 8 units, either PBV or PBRA, following a conversion. RAD is the only option that allows you to carry forward public housing funds. That is true. So this is one of the important things to think about, and we'll touch on this a little bit later today in the decision tree. These considerations relating to making sure that you use all resources available to you to support your efforts. It's an important thing to consider. True or false? When converting to Section 18 or streamlined voluntary conversion, housing authorities are eligible for replacement tenant protection vouchers for units occupied within the previous 24 months. So the slide here says false. I think there's a typo in the slide. It is 24 months. So it's I think that the answer was meant to, or the question was to have said 12 months. So it's you are eligible for tenant protection vouchers for units occupied within the past 24 months. All right, so moving forward, here's some questions that we'll cover today. How do project-based vouchers fit into a repositioning strategy? How are former public housing units treated differently in the context of PBV programs? How does the PHA decide which repositioning strategy fits best? We're going to go back a little bit to comparing RAD rents to FMRs. And how can a PHA figure out how much debt they could leverage? So we're going to go back a little bit to some of these comparisons between RAD rents and FMRs as we get into the decision tree. We're going to start with the intersection of project-based vouchers. So what is the PBV program? So if many of you may have a housing choice voucher program or have worked for a housing authority that does and are familiar that funding comes from HUD to a housing authority through a housing choice voucher ACC agreement. There is a discretionary option within this overall funding that allows a housing authority to project base some of those resources into buildings rather than giving the resource to an individual or a household to then go out and shop for housing, so to speak. A housing authority can choose to project base those resources. A lot of times housing authorities will think about the success of residents within their housing choice voucher program given market conditions and consider at a policy level the trade-off or the tension between choice, which the housing choice voucher program provides, and certainty, which project basing resources provide. And there's in every market that trade-off looks a little bit different, but in tight markets where residents are not as successful because the market is so tight, certainty is valued in a way that causes housing authorities to want to project base. Housing authorities enter into a HAP contract with the project owner, a housing assistance payment contract. Rental subsidy is tied to specific units. So those HAP contracts identify the specific unit and the number of units and the rent levels that will go along with those units. And then specific project-based voucher requirements apply. Some of those requirements have been waived through a RAD waiver, and we'll touch on some of the differences when we get deeper into the presentation. So how do you get to that project-based voucher contract? So options for conversion. So depending upon the size of your organization, there's different eligibility or different paths that you could choose. So beginning with the very small housing authorities. So a very small housing authority could use RAD, and the streamlined RAD conversion to achieve a RAD PBV contract. Or under Section 18, there is the 50 or under, and then obsolescence, scattered sites, efficient, effective, and health and safety justifications. All of those are eligible. If you are at 50 or under, the 50 or under justification is your most straightforward. Under voluntary conversion, which is Section 22, there is the streamlined voluntary conversion, which is eligible to you, and all of the considerations that apply and all the rights which tenants have apply under that version. If you're then a housing authority with between 51 and 250 units, you have the RAD option available to yourself. You have Section 18, and then streamlined voluntary conversion is still an option. And then above 250, you have the RAD and RAD Section 18 blend. You have all of the available Section 18 options, so that would be all of them except for the 50 or less, as with 51 to 250, and then the streamlined voluntary conversion. So those are the paths, and we'll talk about this again a little bit later in the decision matrix portion of the presentation. A little bit about the RAD, a little bit about the PBV process, extremely simplified. Beginning in the upper left-hand corner, Housing Authority would notify HUD that it's intending to have a project-based voucher program. It would run a competition that selects the owner. There is an inspection of those units or that property. A selection occurs. There's an environmental review process that is necessary. That's the Part 58. Subsidy layering review is necessary for many of the types of properties or projects that would be selected. A HAP agreement is entered into between the Housing Authority and the owner. The construction or rehab begins. The determination of rent is finalized. There's another inspection. HAP contract is finalized, and then occupancy of the units begins. So that's a really simplified overview. We'll get into that a little bit more, but this gives you a reference of the path that we're going to walk down. So on with regards to the types of projects that are going to be supported with a HAP agreement. So on the selection date, so this is the date that the Housing Authority chooses to pick a property or an owner of a property for a HAP contract. The project could be characterized in three ways. It could be defined as an existing building, a rehabilitated building, or a building to be constructed. The difference between an existing building and a rehabbed building is defined by that housing authority's admin plan. So if the existing building substantially complies with HQS, Housing Quality Standards, then it is an existing building. If it does not substantially comply with existing HQS, then it is a building that will be rehabbed. This is an important distinction that's made early in the process. The idea of substantially is something that the Section 8 program looks to the housing authorities to define, and ideally that definition is included in your admin plan, so you've got something to point to when you determine whether a building is substantially compliant or not. And then new construction is a little bit more straightforward. The units don't exist at the beginning of the selection, and then they're to be constructed. We'll come back to this concept of existing versus rehab a little bit later. So the importance of existing versus new. So if under existing, projects selected, once the inspection determines, so project selected once inspection determines a project substantially meet HQS. So again, this occurs early. This is done at the time that the housing authority is running its competition or running its selection process to determine if that building or that owner will be awarded a HAP contract. the PHA must determine that the units are fully comply with HQS prior to executing the HAP contract, but that's before the HAP contract is signed later in the process. But during the selection process early, the Housing Authority needs to determine if the project substantially meets HQS. For new or rehabbed, a HAP contract may be executed as a single stage or multi-stage contract. A multi-stage contract allows the Housing Authorities to complete and accept units and kind of grow that contract over time. This will, there's some planning that needs to go on here if you are the administrating, if you're the Housing Authority administering the the HCV program, because it will have an impact on your timing of receiving new vouchers, so net new tenant protection vouchers, and your timing for awarding those to the owner. So there's some planning that needs to go on as you think about your overall Housing Choice Voucher program and how you're going to time the award and flow of subsidy to an owner. What is an AHAP? The agreement to enter into a housing assistance payment contract. So this is the precursor to the HAP. For any project involving new construction or rehab, an AHAP must be executed prior to the start of construction or rehab. RAD is an exception to this. There is no AHAP in a RAD context. But for any other project-based voucher HAP contract, an AHAP is required. As you think back about the different Section 18 avenues that could result in a tenant protection voucher being awarded and then used to preserve that existing building, an AHAP is likely to be necessary. It's not required for an existing unit. So again, here going back to the difference between existing or rehabbed. An existing unit is for this context, an existing unit is a unit which substantially meets HQS, substantially being defined by the Housing Authority. A rehab unit is for a unit which does not substantially meet HQS at the time of the award. Remember that distinction because it has a bearing on whether an AHAP is necessary. A subsidy layering review may be required. An environmental review is required prior to entering into an AHAP agreement. So the program caps. So if you have a Housing Choice Voucher program, your ability to project-base those units is limited by your program cap and then by your project cap. The program cap allows for 20% of your overall program to go to long-term HAP contracts, and then an additional 10% for special PBV contracts if this criteria is met. So if you're in a low poverty census tract, reserved for homeless or vets, if it involves supportive housing or housing for elderly and disabled persons. So it's something to keep in mind when you're thinking about your award or your selection of a project and an award of a contract, would you want those units to fall within the 20% or the 10% set aside? So simple math, 30% of your overall award, 30% of your overall program can be awarded through a project-based voucher contract, leaving 70% available for your more standard Housing Choice Voucher program that's awarded to residents who use that money to seek out a unit on their own. There are some exceptions to this. The VASH program is an exception. RAD units are an exception. And units that are awarded a project-based voucher which have previously received certain federal housing assistance or public housing assistance. For public housing, it's if the property has received it within the last 5 years. We'll touch on this more throughout the day as well. Those exceptions are removed from your calculation of your cap. They're removed from the numerator and the denominator as you determine how your program is measuring up against these limits. Income mixing. So in this context, income mixing refers to projects which have project-based voucher, projects which have units covered with a project-based voucher contract and those that don't. So income mixing here is sort of a project which would have PBV units and not have PBV units in the same ownership entity. In that instance, there's a project cap. So the greater of 25 units or 25% of the units within a project, that's the general rule. There are some exceptions to that. So again, there's this, call it this public housing exception. So if the property receiving the HAP is a former public housing property and it had received subsidy within the last 5 years. There's also an additional exception to that if your project happens to be located in a low poverty census tract. In that case, the project cap is the greater of 25 units or 40% of the project. There is also an exception for projects which are entirely focused on elderly families or families receiving supportive services. And services are defined in the applicable HUD notice. But so if your project is special needs or elderly, generally speaking, it is also accepted from this cap. Program and project caps in the context of repositioning. Units being repositioned from public housing are generally exempt from the program caps. Again, we talked about this before. If it is a public housing site which had received public housing subsidy in the last 5 years, you're exempt from the cap. There's exceptions to the exception, and those, I'm not going to go into all of those, but I draw your attention to PIH Notice 2017-21 and Attachment F. There's a lot in this notice, so if you want to have one notice to go to that gives you a pretty good overview, which also includes examples, so it gives you some hypotheticals to make it real so you can understand what the rules mean. This is a great notice to take a look at to understand how some of these rules apply to specific instances. Again, 2017-21F, original units. In the context of repositioning, thinking about your program caps and your project caps. If your public housing unit had received subsidy in the last 5 years and you want to reposition it to a project-based voucher contract, using any one of the available Section 18 justifications, you're exempt from the cap. The units that are receiving the project-based vouchers must be on the same site, and you're limited by the number of, constrained by the number of units that were on that site as it operated as a public housing site in the past. If you choose to increase your density on the site, so say you wanted to redevelop more units on that site moving forward than had existed as a public housing property, you would then both consider this exemption for units which had previously received public housing and apply the other project caps once you exceed the number of former public housing units that were on that site. So the idea of redeveloping really old, low-density housing is something that is happening a lot, that is permissible, and then you need to think through how these different layers of rules would apply in that instance. Christina, I think I'll stop there and see if there's any questions. We covered a lot, and give folks an opportunity to ask any questions they might have.
We do have one that's just come in.
Do we want to try to unmute the person?
Yeah, let me see if we can find. So Stacy, I am unmuting your line.
Okay. Hello. One question I have is, if we were to transfer assistance to a new project under RAD, would we still be able to project-base those units?
Are you referring to the RAD transfer of assistance mechanism?
Yes.
Yeah. So that would still be a RAD project-based voucher contract. So it would, all of the RAD PBV rules would apply. You also have to go through the transfer assistance process that we had talked about previously, but you can go from a traditional public housing property, transfer that assistance to another property that has been appropriately selected and approved, and then enter into a RAD PBV contract for that receiving site.
Thank you.
You're welcome. Any other questions pop up, Christina?
Not seeing anything right now.
Okay. Okay, so we talked about program caps, project caps. Let's talk a little bit about the selection or the competition. So as a general rule, housing authorities that wish to project base some of their housing choice voucher program into properties to create that certainty or achieve other desirable outcomes, like preserving a building, need to have a competition that's generally done through a request for proposal or an RFP. There are some exceptions to that rule. So the one exception is referred to as the previous competition. So under this exception, if the owner or if that project and the owner of that project that is desirous of receiving a project-based voucher contract has been selected through another competitive process and awarded funds. Most commonly, the award of a 9% tax credit allocation is pointed to as an example of this other competition. Then the housing authority can piggyback on that competition, so to speak, and award project-based vouchers accordingly. The prior selection, so let's say it was an award of 9% tax credits, the prior selection must have occurred within the prior 3 years, and that selection could not have been based upon the project having project-based vouchers. So the PBVs were not considered in the previous competition or were not a basis for that award, and it must have occurred in the last 3 years. So previous competition is one exception. Another exception to the no competition relates to the involvement of the housing authority in the future project and the project itself. So so this is the right side of the box I'm speaking to now, and it's kind of like it's a teal color around these boxes. So if the housing authority, who is the administrator of the housing choice voucher program, has an ownership interest in the entity receiving the voucher contract, who is the owner of the project, then there's eligibility for no competition. We'll talk about some of the ownership interest issues later. So that's the left side of the box. And that the project itself will improve, develop, or replace public housing on the project, on a property or site, and the cost threshold for this rehabbed property, or I guess newly constructed property, but I can't think of a market where new construction would meet this or need to meet this criteria. But if a rehab property needs to spend at least $25,000 per unit. So this is I'm going to pause on this one a second because it's important to go back to the question we talked about earlier about existing versus rehabbed. So if it is an existing project, then this would not apply. So if the housing authority had previously determined that the selected project, substantially meets HQS, then it's an existing project, and this criteria under competition is moot. If the Housing Authority previously determined that the project did not substantially comply with HQS, and therefore it is a rehab project in the eyes of the PBV rules, you have to look to the dollar threshold which is being spent on the project to rehab the project to determine if no competition criteria with regard to the public housing ownership is also met. I'm going to pause on this one as well because there's a lot here and see if anyone has any questions. Anything, Christina?
Nope, nothing's come through.
Right. And then the very bottom of the slide is addresses the waiver which RAD conversions have on the competitive requirements. So it's if you're transitioning through Section 18, the majority of the slide that we just spent some time focusing on applies. If you're converting through RAD, then it has a waiver in place. One last point about this slide to make mention of that's important. If you are a housing authority which has a public housing program, but you do not have a housing choice voucher program, and you identify another housing authority who's willing to serve as your housing choice voucher administrator for purposes of using PBVs to project-based subsidy back into your public housing that you're trying to preserve, then this criteria or this exception relating to the public housing ownership relates to the housing authority administering the contract. So if you're sitting on this call, you likely have a public housing program. And if you're on this call and you don't have a housing choice voucher program, but you found a housing authority nearby who's willing to do this for you, in order to meet this criteria, it's that administering housing authority that would need to have the ownership interest in the project to meet the ownership exception. Keep going here. So let's talk about the PHA ownership. So in the eyes of the project-based voucher program, the PHA ownership is achieved if the building is owned by the housing authority, if it's owned by an entity wholly controlled by the housing authority. So that could be a limited partnership, an LP, or an LLC, a limited liability company. And again, the housing, we talked about this in prior sessions, the housing authority need not be the sole member. It only needs to have some stake in the partnership or the LLC. Continuing on, environmental review. So a Part 58 environmental review is necessary as a criteria or as a factor to enter into an AHAP or AHAP. So your Part 58 review will result in a release of funds, or sometimes called an ROF. The Part 58 review may identify some mitigants that are necessary. So if you're familiar with this process, you know that it is a process that has you comparing your existing project against your proposed alternative and determining whether your proposed alternative will have any adverse impact on a list of things that relate to, broadly speaking, environmental factors. So it could be water, air, historic preservation, impact on people. There's a long list. The extent to which your project is determined to potentially adversely impact any one of those factors, and a mitigant is identified, you have to carry out that mitigation as a condition of entering into the HAP agreement. So I want to stop for a second on this slide and go back to some of the Section 18 and even the RAD process that we talked about before, both of which require or can require a Part 58. When you're completing those Part 58s early in your process, when preparing, particularly preparing your Section 18 application, that would be much earlier in your process than we are right now. So right now we're conceptually deeper into the development phase because we're talking about entering into a HAP agreement between the housing authority and the owner. Much earlier in the process, we were talking about how we get HUD's approval for a Section 18 disposition. And that a Part 58 environmental review is an element of that Section 18 application. If you're pursuing Section 18 and you anticipate that you will ultimately project-base your tenant protection vouchers, it is very helpful to you to identify during that early Part 58 process that one of the activities that you are going to perform is leasing to low-income households and using or anticipate using a project-based voucher contract to make those units affordable. If you identify that activity as part of your preferred alternative when you're doing your Part 58 much earlier in the process, you can use that Part 58 as the environmental review, Part 58, that is needed to satisfy the project-based voucher requirement at this point in the process. If you don't identify leasing to low-income people using a project-based voucher contract during your Part 58, which is done as part of your Section 18, then you have to do it again. So to save everybody a little bit of time and money, broadly define your project and your activities during your Section 18 application, Part 58, so that it can be used as part of your project-based voucher, Part 58. PHA-owned independent entities. So if the housing authority is, or an incarnation of the housing authority, is the owner of the property that is receiving the HAP contract. So it is on one side of that, it's on the receiving side of the HAP contract. Then an independent entity must be identified to perform some of the housing choice voucher administration tasks. So the idea here is that it's kind of self-dealing, I guess, that you can't be both the regulator and the kind of grantor of the resource and the recipient of the resource and do both sides of that activity. So the specific activities that you need to seek an independent entity to assist with are the review of the selection process, to make sure that it was fair and open, review of the HAP contract, to make sure it's a fair and reasonable contract, to determine that the initial rent and to conduct the annual rent redeterminations is reasonable, HQS inspections, and the review of the rent reasonableness. So matters relating to selection, determining rents and contract term, and the physical inspection of the units. Those tasks need to be performed by an independent entity if the housing choice voucher administrator is party to the ownership entity of the project that is receiving the vouchers. Any questions about any of those things? I think a hand went up, Christina. Can we unmute Anne-Marie Flower to ask her question?
Hi. Hello?
Hi, go ahead.
My question is it these items that have to be independently handled if the PHA is owner of the project-based property, some things I can see you can outsource, obviously, on a day-to-day, but are there some things that could be considered more of an audit function, that they come in and they audit your selection process, they review the length of HAP contracts? So what I mean by that is something that you don't have to, you have another company come in and check all this, audit it on a regular basis, but it's not like you're handing over the operations of those particular vouchers, the processing of them, to another entity and paying for that expense.
It's a good question. So I think it would depend upon which task we're talking about. And as it relates to the selection, I believe the criteria is review the selection process. It's not necessarily conduct the selection process, but review the selection process.
Got it.
And then on the contract terms, the contract term is probably that one's of all of these, the one that is mostly a given. I mean, your contract term is going to be between 15 and 20 years. The HQS and the rent reasonableness need to be outsourced. So those need to be done by an unrelated party.
Okay, thank you.
Is there any other questions? Yeah. Okay.
Yeah.
Okay. Subsidy layer interviews. This is another component of the process that you need to complete as you're working towards entering into a HAP agreement. So a subsidy layer review is required where there's a newly constructed or rehab project. It's required before the AHAP. So again, if it's an existing project, and we talked about this, so existing project being defined as a project that substantially meets HQS, substantially defined by the Housing Authority, and that determination made at the time of selection, then a subsidy layer review is not required. But if it's new construction or rehab, a subsidy layer review is required. It's required before you enter the AHAP. The subsidy layer review may be performed by HUD or a HUD-approved agency. Typically, this process involves the Housing Authority gathering all of the information. There is a checklist that folks can find and follow to see what goes into the subsidy layer review. There's a lot of information that all point to the financial terms of your project. So a lot of information about sources of funds, costs, both capital and operating sources. An important thing to keep in mind with the subsidy layer review is that given what goes into the subsidy layer review, it by definition has to come later in the process. So subsidy layer review often has to have pretty firm commitments or commitments which would come deeper into your development process. So as you're thinking about when you would slot your subsidy layer review, to keep that in mind. If you look at the checklist, you'll see the types of things that are required, and you can imagine that you're closer to closing than not. So this is something to keep an eye on as you're thinking about the mechanics of your process, because you don't want to wait. The subsidy layer review itself takes a little bit of time. You don't want to wait until you're immediately upon your desired closing date to submit your subsidy layer review. So you want to back up a little bit from your closing date and submit with enough time that you can get it reviewed and approved. But you have to be deep enough into the process to have all the elements of your subsidy layer review to submit a full package. So you want to spend enough time managing the collection and submission of this. And it's often, I find it's helpful to work with your field office to let them know it's coming. So they have an early heads up. They can work with you and know the project, so they don't receive it cold, and that you can ease the facilitation of your review and approval of the subsidy layer review. Setting rents to the owner in a NOD-RAD context. So the rent for a PBV unit is the lower of the Public Housing Authority determined amount, which can be up to 100% of your FMR, the rent amount in the PBV context is slightly different than what we talked about, is different than what we talked about with RAD. So the rent amount would be that FMR amount less, or your approved payment standard for if the housing authority has one, less your utility allowance. So that becomes the rent paid to the building through the HAP contract. The rent amount paid is also governed by the rent reasonableness. So this is kind of a market evaluation that is done immediately prior to entering the HAP contract to make sure that the individual building that is going to receive this HAP contract is comparable, it's reasonable to other like buildings in the market and warrants that rent amount, or any owner requested amount. The HAP contract itself can cover a single building. If you have a large building that was, say you have a 100-unit former public housing building on a single site, you'd have a single HAP contract for that building. Or say you had a 3-acre site with many buildings on it. So you've got 10 buildings on your 3-acre site. Your HAP contract would cover all of those buildings on a contiguous site, or on a single site. Or if you have multiple buildings on contiguous parcels, so your land parcels touch, you would have a single HAP contract for all of those buildings. And then there's this last one. If you are a housing authority that is in a situation where you have multiple scattered sites that you are wanting to reposition, so this one really relates to someone who might choose to use the Section 18 scattered site. If you're using the Section 18 scattered site option and you receive approval and you wish to project base back those units, if your sites are non-contiguous and if your buildings have 4 or fewer units, those can be bundled into a single HAP contract. If they are bigger than that and you want to bundle, you would need multiple HAP contracts. So a single HAP contract is available if you have multiple sites, multiple parcels, non-contiguous, with buildings containing 4 or fewer units. If you have more than 4 units, then they would need to be in more HAP contracts. Christine, was there a question?
I am.
Like Anne Marie may have a question again, or is that from the prior?
Let me unmute her. I don't think her hand ever went down. That's controlled on the participant side. Anne Marie, did you have another question? Nope, her hand went down, so.
All right. Okay, sticking with the HAP contracts. The maximum initial term of a HAP contract under the PBV program is now 20 years. Those contracts can be extended. Multiple extensions are permitted. The first extension of a contract may occur at any time during the initial term of the contract. So you could imagine that in concept, the housing authority could offer the owner an initial contract of 20 years and then a first extension of 20 years, allowing for an effective initial term of 40 years from the outset. The subsequent extension, so your second extension on, can occur no earlier than 24 months prior to the expiration of the term of the contract. So in order to get a second extension, you need to wait till you're within 2 years of the end date. The term of the PBV RAD contracts are different. And again, those are between 15 and 20 years, and that contract renewal is mandatory. We talked about that in our first session. Eligibility to move with a housing choice voucher. Oh, Christina, is there a question? Okay. Eligibility to move with a housing choice voucher. Participants who are living in a unit that is subsidized with a project-based voucher have the ability to identify themselves as wanting to move and then be awarded a voucher. And there's some ifs on that. So the participant, if they choose to do this, would receive the next available housing choice voucher within that housing choice voucher program. So they effectively get to move up on the wait list. So if I live in a project-based voucher unit and I identify to the housing authority that I want to move after I meet applicable rules, then I would move to the top of that list. I must give my notice, pardon me, in writing to the pardon me, housing choice voucher administrator, and I must have lived in that unit for a year to be eligible. I might be thinking about this, I might be planning for it, I give written notice, and then if there is a voucher available in the housing choice voucher program, I can be awarded that voucher, and then I can choose to seek an alternative place to live. There are some exceptions to this that relate to domestic violence that are listed here. So there's some carve-outs where you don't have to wait if you fear that you are at risk of violence. A couple of things to think about in the context of the housing choice voucher program itself. So mobility will impact the wait list. So if you have a bunch of project-based voucher units in your overall program and you manage a wait list, and if PBV residents self-select as wanting to move and they've been there a year, they go to the top of your wait list. So this can have an impact on how you pull from your wait list. Funding is subject to proration. So after the initial TPV RAD funding award, the new budget authority, your annual budget authority, is subject to proration. So this is not that dissimilar to how your programs run now, but something to keep in mind. And depending upon what future prorations look like, a smaller program could end up with percentage changing if proration goes down. So just something to be aware of, something to think about sensitivity analysis in your overall program if you are running up against any caps. In the event of a shortfall, and this shortfall could occur for a couple of reasons. Could be proration. It could be just cost of program increasing. The housing choice voucher administrator needs to think about how they're going to manage that. So you basically have a choice here of whether you're going to slow down the lease up of your housing choice voucher program, tenant-based approach, or whether you're going to look at your funding obligations on your project-based voucher contracts. I have never known of a housing authority to, I actually don't believe that they could, but I've never known of a housing authority to not honor a PBV contract. Typically what happens is that when folks are up against shortfall, that they manage their housing choice voucher program accordingly until they achieve the necessary balance again. Some key operational differences from the HCD program. So housing quality standard inspections of a random sample and all new admissions. So it's all units are inspected through the PBV program. Let's see, based on terms of the PBV assistance, contracts will continue to flow subsidy for 60 days if a unit is vacant. After that 60-day period, the rent will stop. So the owner has a small window, 2 months, to turn those units and fill it with another qualified resident. Otherwise, they do not receive rent. Your admin funding will continue. The voucher administrating agency will continue to receive the admin funding as long as the units are appropriately reported in VMS. There's a slightly different 50058 process. There's no 40% rule. So here the family's share of rent is their tenant, the total tenant payment minus the UA. RAD there's an exception for RAD here. We talked about the phase-in if there happened to have been a flat rent paid by families. So there's a phase-in that brings those RAD PBV households slowly up to their new rent amount so that it isn't a jarring change. And then again, on the PBV amount, so turnovers are important here. So units should be filled quickly to eliminate any possible shortage of your revenue under our HAP contract. A couple of key takeaways. So unless the project includes RAD units, there is no ability to phase in the tenant increase. So if there is a household living in a traditional public housing unit now, and you want to shift them to a project which you preserve through a project Section 18 approval and then a presumptive HAP agreement funded with tenant protection vouchers, their new rent is set based upon PBV rules, and it begins immediately. So it's practically speaking that it's good for the housing authority to understand the profile of your households so that as you're working with them through the whole resident engagement process, you can understand their situation and realize what impact this rent change will have on them. It's best not to wait until you're going through the recertification at the very end and realize that there's going to be a shift. You should have enough information either in your profile now or information you can gather through your resident consultations to make sure that you don't have a jarring change for any household. So I encourage you to spend some time thinking about the rent change early in the process. PBV units must fully comply with housing quality standards prior to the effective date of the HAP contract, unless the housing authority is going to implement some of the alternative requirements. So the HQS inspection occurs prior to funding flowing to your building. This is also an important thing to think about because you need to make sure that you queue up your HQS inspections at the end of your rehab, potentially while residents are living in those units if you're doing an occupied rehab, potentially using your independent entity who does your HQS for you. So that logistically, this takes a lot of coordination. So you don't want to find yourself in a situation where your HQS inspections are taking a bunch more time and you're not able to start the funding flow of your HAP contract, because that will impact your stabilization, could potentially impact if you have debt on your property, your conversion to perm. So you want to get that lined up early so that it can go smoothly and your funding flow under your HAP contract can begin as quickly as possible. Some important resources. So we talked about this PIH notice a bit earlier. so 2017, 21, not terribly long, but it's a great document. It gives you a lot of information about project basing, and again, it gives you some good examples to take these concepts or these rules and put them in a real life scenario. All right, so a couple of knowledge checks. What does PHA-Owned mean? What does PHA-Owned mean? PHA-Owned means that the building is owned by the housing authority or an entity that the housing authority has a controlling interest in. That could be a wholly owned or wholly controlled nonprofit subsidiary. So that could be an affiliate or an instrumentality of the housing authority. Both work. It could be a limited liability company or a limited partnership. True or false? If a unit is considered PHA-owned, the PHA can do its own HQS inspection. If it's PHA-owned, the housing authority can do its own HQS inspections. False. You may not do that. So there needs to be some arm's length between a few of the HCV administration tasks. Inspecting the quality of the unit is one of those tasks. What is the maximum length of a PBV HAP contract? 20 years. All right, so we are about an hour into it, and unlike how we did this last time, I'm going to take a 5-minute break here, give folks a chance to get up and do what they may need, and then we'll come back to it and get into the program matrix and decision tree, and then a final knowledge check, and then open it up for the Q&A. So by my clock, it is 2 minutes after the hour, so we will resume at 7 minutes after the hour, so a 5-minute break. Thanks, everybody. All right, welcome back. You had a chance to refill your cup or stretch your legs and settle back in with us. We're going to continue now through the second half of today's presentation and talk about the program matrix and decision tree. As I mentioned at the outset, this is where we're going to get into how to take some of the concepts and rules and strategies that we discussed during the RAD, Section 18, SVC, and project-based voucher elements of the webinar, and bring them together and talk about how you would go about evaluating your proposal and making decisions around the best course of action for your particular portfolio or projects. So we're going to use a couple of slides, and none of these slides stand alone as the way to determine the best tool. They all are taken together, and then for you and leadership of your organizations to use your best judgment and figure out which option is right for your situation. So we're going to go through a couple of slides here that give you different ways to think about the different aspects of a repositioning. And then we'll talk about how we bring it together at the end. We looked at this slide during the RAD, during our first session where we talked about the introduction. And this slide identifies the tools available for conversion and the type of Section 8 contract that is the result. So you might recall that RAD is the only repositioning tool which allows the Housing Authority to select either project-based rental assistance, PBRA, or a project-based voucher contract. And so there's a decision there for a Housing Authority to figure out which one of those two types of Section 8 do they think is best for their situation. Section 18 allows a Housing Authority to either project base the tenant protection vouchers, which may have been awarded or will be awarded, into the building, which is being repositioned, or allow for the residents to voucher out. So take those vouchers and choose to live somewhere else. And then streamlined voluntary conversion is the type of repositioning option which is more focused on the resident and mobility, less focused on preservation of the building by virtue of its rules and the standing which it provides for existing residents. This slide, I like this slide. This slide is a way to think about how the capital needs within your building can be addressed and what type of conversion tool is likely better suited for you to attract the capital needed. So the bar which has the color from green to red is a bar that reflects the amount of capital needs needed. So green in this slide would illustrate a building that's in really good shape. So no capital needs or very little capital needed in this building. Continuing to the right through red where there's a significant amount of capital needs needed. The black bar here is intended to identify the threshold for determining obsolescence. Again, you recall that the Section 18 obsolescence threshold is a dollar amount that is tied to the current physical needs of the building, things that are currently, I hesitate to use the word, but currently broken, not simply old, but needing to be repaired because they are not working. So if your building meets this obsolescence threshold, it means that there's a lot of work to be done in the building. So you're on the higher end of the capital need. The boxes down below then illustrate some of the financing schemes that go along with those types of capital needs. So a no debt or straight conversion would mean that you're simply you're just changing the subsidy from traditional public housing to the Section 8 platform. Continuing to the right along the capital needs barometer, there's some rehab that's needed, and you can do that with maybe just debt and or 4% low-income housing tax credits. As you continue up the capital need barometer, you're doing more work, so you potentially need more capital, and that more capital can come in the form of additional debt, which is supported by the use of tenant protection vouchers or the revenues that come with a tenant protection voucher, augmenting your revenue, either through the RAD Section 18 blend, the 75-25, or if you're able to prove obsolescence, a 100% TPV building, which has all rents at the index to the FMR, and then blending that with either 4 or 9% credits. So under that scenario, you're able to leverage the maximum amount of capital that is available given the economics of your project. So you're spending the greatest amount of rehab, so your basis is the greatest. Using the 9% credit, you're able to attract the greatest amount of equity. And then by maximizing your net operating income by using tenant protection vouchers, you're able to increase your borrowing capacity to the greatest possible extent. And that allows you to put together the capital needed to fix your building. So that's the continuum, from no debt through substantial rehab using 9% credits and a full Section 18 obsolescence. So depending upon where your building fits on that continuum, you can think about what strategies are best aligned with your needs. And again, this would go on top of thinking about these strategies. Again, so is it RAD, is it Section 18, is it PBRA or PBV? This slide brings some of these concepts together and provides a decision tree that helps you organize your thoughts around your desired outcomes, and then lays out what options are best suited for those desired outcomes. And so there's 5 key tiers to it. So starting in the upper left with the first and fundamental question. So is it the Housing Authority's desire with a particular project or property to preserve that asset? So you want to keep that building in your portfolio, you want to fix that building, you really like that building, you just need to make that building better. So you want to preserve it for low-income people. Or do you want those residents to be able to voucher out, and that building would presumably no longer be an affordable housing building? And now you've got some questions about what you're going to do with that site, but the residents living there are no longer going to live there. So if you want them to voucher out, then Section 18 or streamlined voluntary conversion are your options. So you need to think about the eligibility for Section 18 or streamlined voluntary conversion. If you want them to voucher out, you would receive a tenant protection voucher that would allow for that. If you want to preserve the building, then you can think about your next set of questions. So here, the next fundamental question is to compare your RAD rents to what would be your PBV rents. We're going to go into that again. We're going to review some of that in the next couple of slides. But so fundamentally, you want to understand which option would provide me the greatest revenue. If my RAD rents are higher, then I go RAD. If my RAD rents are lower, then I'd go to my next question, which is whether I'm eligible for Section 18. So if I'm eligible for Section 18, there's a couple of questions to ask to determine if I'm eligible for Section 18. So based upon size of the housing authority, based upon whether my units are scattered, whether I'm obsolete, whether it's inefficient and effective. So if I'm eligible for Section 18, I can prove that, I can justify that based upon all the criteria, then I go Section 18. If not, then I still have a couple of options. So I can consider streamlined voluntary conversion. And again, so here I'm thinking through whether I can preserve my building or not. So if I'm eligible for streamlined voluntary conversion, because I've got 250 or fewer units, and I think that the residents will consent to relinquishing their voucher back to me so that I can project base it in their building, giving them the option to continue to live there, then streamlined voluntary conversion is an option for me to preserve that building. If not, then my next option is whether or not I think I can meet the obsolescence test. If I think I can meet the obsolescence test, then I go Section 18. If not, if I've exhausted all these other paths to preserving the building, then I can go RAD. So basically, the layers here, 2, 3, 4, and 5, are based upon a desire to preserve your existing building. You've determined that RAD rents are lower than Section 18, and you're exploring all the possible ways that you can access a tenant protection voucher, beginning with Section 18, going through the various options, so scattered site, 50 or less, efficient, effective, health and safety, obsolescence. And if you can't prove any of those Section 18 justifications, or if streamlined voluntary conversion is not an option to preserve, then RAD is your available option. So again, this is kind of a thought process to consider how the different tools available can allow you to access your desired outcome. So this question of preserve or voucher out. So it's the first question that I think the Housing Authority needs to wrestle with. And it's fundamentally, do you want to keep that building in your portfolio, or do you want to allow the residents to move out? So some of the things to think about here. So if your building is in a poor location, if it's too expensive to run, if it is, you think you've got a better alternative to deploy that subsidy elsewhere, there's a variety of reasons why it might be a poor location. You might want the residents to voucher out. And again, they can do that through streamlined voluntary conversion or Section 18. If you don't qualify for streamlined voluntary conversion or Section 18, you can use RAD transfer of assistance as well. So that becomes a method using the RAD, or which would result in RAD rents that allow you to shift your assistance from the current building, your current traditional public housing, to a receiving building. If you choose to do that, your property can be sold, and those proceeds can be used to support your RAD rehab or another the creation of another project that is not funded through RAD. It might be another PBV project. So you have some choices to make about what you're going to do with that property if you decide to allow the residents to voucher out. Comparing rents. So this is a slide that illustrates this difference that I had mentioned before. So in this box, we see an example of a RAD rent of $600. So if you recall from our first session, we said that a RAD rent plus a utility allowance is your gross rent. So that $600 is the RAD rent. So if you're doing this comparison, you compare the $600 to what would be the rent paid to the building under a PBV scenario. To determine that number, you can look at what is so here we're using 110% of FMR, so in this example, that's $800. You could also substitute the payment standard for that. So if the Housing Authority has a set payment standard, you could substitute payment standard for 110% of FMR in this scenario. You subtract from that number, in this case the 800, the utility allowance of $100. We're down to $700. So $700 is the amount of money that would be paid in the HAP contract to the owner of the building. Now we need to confirm that that's a good number. So if you remember from an earlier slide today, we talked about that the rents in the HAP agreement are the lesser of certain things. Rent reasonableness is another one. So the Housing Authority took a look around the market area and determined that similar building types with similar sized units are getting $900 in rent. So that makes some sense. So the Section 8 program is often slightly below market. So rent reasonableness is 900. So our PBV rent of 700 works. So in this scenario, the $700 PBV rent is $100 greater than my RAD rent. So in this scenario, I would choose to go Section 8. I would choose to go Section 18 because the rent is higher. And yeah, I want to make sure folks remember where to get this information. So again, here's the link to the site. I don't think this link is hot, but that's the URL. So you can find this information on the RAD resource desk. So if you look for the 2018 RAD rents, again, I'll do this for you. There was a couple of questions in the surveys from the last session that asked about. We're going to review where to find information. So I'm going to take a moment and do that again. So Christine, I'm going to share my screen. So if you could give me a feedback on the scale, I'll make sure that folks can see. Appreciate that. I'm just going to Google 2018 RAD rents. See, this link comes up. I'm going to open the file. I'm going to say don't update. Here's that file. If you're curious about the link, this column right here, column P, all these columns just have numbers in them, but column P has a link to, so you can just say don't update and it'll keep your numbers. So here's where you can then go to your search for your housing authority.
If you can, it might be helpful to go just a little bit bigger.
Sure can. How's that?
Yes, that's good.
And I think it's useful to use these pull downs. If you sort, remember friends in Southern California, our example, you just put in sort by your PHA code, and then you'll receive only the rows which have AMPs for your housing authority in them. If you want to do this for your own housing authority, I like to just select all these rows and then copy and then open up another spreadsheet and paste. And that way I've got a single spreadsheet with only my housing authority's data in it. And I don't have to continuously scroll through a lot of other housing authorities. So it allows you to isolate just what you want to see for your own housing authority. And then here, again, it'll show you by project name, by AMP, the number of units in total, the number of units by bedroom size, the existing public housing subsidy amounts, which your RAD rents are based upon. So here's these three amounts: the capital grant, the tenant paid portion, and the operating subsidy equal $926. There's my $926. That's my weighted average, which also is then the weighted average for the RAD rents for that AMP. It then compares them to FMRs. And if you want, in your own spreadsheet, you can, over here to the side, do a little math and subtract your FMR amount from your RAD amount to see what the dollar difference is. This percentage number here gives you an indication of which is going to be higher. So in column R rather, if column R is less than 100%, that tells you that your FMR rent is greater than your RAD rent. So it's roughly by half in this case. So the RAD rent is 48% of your FMR. What might be more useful to you as you get into running numbers is to know the dollar difference, so that you can understand what that is actually going to mean for your operating budget. And so what I would do is just over here in this cell, subtract FMR from RAD rents to get that dollar difference, and then to put this into scale. In this AMP, there's 146 units. So here, if I did $146 divided by the difference, so that's $87,000 a month in increased revenue for that AMP because of the differences between FMR and RAD. If I then multiply that by, forgive the dollar signs there, that just the formatting is set up that way. So if I take that 87,000 a month and multiply it by the number of months in a year, for that AMP, given the differences between FMRs and RAD rents, my AMP would receive $1 million difference, $1 million more in revenue, if I were able to show that a Section 18 award is justified. And again, so then I have to go back and understand, well, what are the rules around eligibility, and can I justify that I qualify? So am I 50 or less? Am I scattered site? Am I obsolete? So the economic difference for AMP 001 in the city of Oxnard is significant. If I think about the dollar difference per unit per month, multiplied by the number of months, number of units, multiplied by the number of months in a year, it's $1 million. So it's that process to go through to think about what is the real economic difference between RAD and Section 18. All right, so I'm going to stop sharing my screen and go back. And I think I'll stop there as well and see if there's any other questions. But it looks like we might have had a couple have come in. Christina, can you?
We had a question from Melanie come in. I'm going to try to unmute your line, Melanie. Go ahead, Melanie, if you're there.
Might have stepped away.
Yeah, we had, I'll keep the line unmuted for a second, and we had another question come in while we wait.
All right, I will keep going through the slides, and then if folks do have questions about the rent differential, we can circle back to those. Next couple of slides, we're going to go into the stuff that we just covered. So here's the link. So www.hud.gov/rad libraries notice. Again, that's a place where you can, there's a lot of information, including the 2018 RAD rents. I encourage folks to download that file, keep it on your own server, and tailor the file as you want to make it work for you to really understand what some of these differences mean in your community. It's great information HUD's making available They intentionally do it in a spreadsheet, so you can modify that spreadsheet on your own and to add some value to it to work with your own problem solving. I think we have another question from Angela.
Angela, you're unmuted.
Okay. Can you hear me?
I can.
Yep.
Okay. So did you, on the slide before this, it was, the calculation was 110% FMR, but you said if we have a payment standard. Mm-hmm. So do we use the payment standard or 110% FMR?
So, great question. For purposes of this slide, and for purposes of the these comparisons, FMR is typically used because that's available information, and it's what payment standards are indexed to. If your housing authority has set payment standards, I would use those. So your payment standard should be within the percentage range of your FMRs that is permissible. So if your housing authority has payment standards and you use those payment standards to determine PBV rents, use your payment standard. If you don't have that, or if you're trying to work in a community and you don't know what those payment standards are, for the purposes of this planning, using 110% of FMR is a fine approach to planning. Using payment standard just gets you to be a little bit more granular, a little bit more dialed into specific information if you've got it.
Okay, perfect. Thank you.
You're welcome.
So Melanie, the first question we tried to pick out, she doesn't have a speaker, so I can't read that question out. Just need to scroll back. It says income limits for public housing are quite a bit different than the HCV program. Is a transition plan required for those families that would be over income when converting to PBV?
Great question. So to be eligible for the PBV program, you need to meet the income qualifications. So that needs to be a factor that is considered. And as you step back a little bit from the PBV program, something for housing authorities to keep in mind, if you are looking to use low-income housing tax credits, it might be that the income limits imposed by your low-income housing tax credit allocation might even be lesser than what the PBV limits are. So generally it's important to think about all of the income restrictions that may be applied to your project as a result of all funding sources to be used, and then it's the lesser of all of those which you need to live by. With regards to PBV, there's a couple of layers to this that I might ask Eva to join in answering this question. But the household would need to qualify in order to receive a voucher or live in that PBV unit. If they don't qualify, you have a choice. They could reside in that unit, but that unit wouldn't receive PBV assistance, and they would pay a rent amount which the housing authority determines. So that might be an option available to you, but whether or not that is available would depend upon a more general thought about how you're financing your building. But the household would be rescreened or would have to meet the eligibility as it relates to income for the PBV program.
And if we determine the market rate is 900, is there going to pay 900? That's the question.
So is there another question?
We have another question. Okay. Steph, are you there?
Hello?
Hello, we can hear you.
Okay. Back to the rent reasonableness, where you said if it was like $900, then why could we not charge the $900?
So it's the lesser of, and I guess this would go back to what your limits set by FMR are. So under this scenario that on the slide that we're looking at, the $800 is 110% of FMR. So you're on the top end of that available range based upon what FMR says your rent can be. So unless the Housing Authority has done something that would kind of modify what its available range is, you're bound by that baseline rule. If rent reasonableness, which is maybe another way to say what market rents are in that neighborhood, is greater than the Section 8 program, and what that tells you is that you're slightly below market. It might tell you that your FMRs are lagging what market is, which is pretty common, but it doesn't become the basis for setting your Section 8 rent to market. It's a good point of information, but it's not justification for increasing the rent, in this case, by $200.
In what circumstances, then, could you go to 120% of the FMR?
I think that Ava, maybe you could help with this one if you're available. I think the range might be 120 to 80 to 120 right now.
Yeah, hi. So basically, the project-based voucher program caps the amount that the PHA can offer, and so the rent is capped by the lower of the reasonable rent or the amount that the PHA can offer, and the PHA can offer up to 110% of FMR or up to the amount of any exception payment standard that's in place. So if the Housing Authority has an exception payment standard for the area in which the project-based vouchers are located, then the Housing Authority could offer higher than 110% of FMR up to the amount of the exception payment standard. Or if the Housing Authority has used a small area FMR exception payment standard, then the rents could go up to that amount. So it really is just a matter of whether the Housing Authority has implemented anything that can allow the Housing Authority to offer any more than 110% of FMR.
And Ava, when a Housing Authority does this, that's a program-wide approach, right? So if they're going to use small market FMRs, or if they're going to go off the baseline in some way, that's a programmatic decision rather than a project-specific decision?
Okay, thank you.
That's a question.
Yeah, so a lot of our exception payment standard options work based on a small area within the Housing Authority's jurisdiction. So I would just, take a look at 24 CFR 982.503 to see for if Housing Authorities want to select a different payment standard for a specific area, not their entire jurisdiction. So zip code level, for instance, if they wanted to do a small area FMR.
So so you can break your overall service area down into logical pieces depending upon what markets are, but it's not a project specific decision. It's a decision that they think about generally what's going on in my community and how do I best allocate my resources. It's not how do I make my project work.
Yeah, I think you're asking whether you can have an exception payment standard for just your project, and the answer is no. It's for areas within your jurisdiction.
Yeah. So it's not a way to solve for any issue you have with a particular project, but it needs to be you need to step back and see what makes sense in your community. Any other questions?
I believe we have one from Anne Marie. I just need to scroll up to unmute her line. You're unmuted, Anne Marie.
Hi. My question is related to, okay, the Housing Authority retaining ownership using streamline conversion or Section 18, and the issue of purchasing the property at fair market value so that you can utilize it in the future by mixing the incomes rather than holding at the 80% AMI. Is there any work around that? Because I can understand that the Housing Authority would have a challenge in trying to get a mortgage to purchase the property and rehab it at the same time. It doesn't need a lot of rehab, let's say, but it seems like the only choices are you either purchase it at fair market value or less. If you go less, then it's a 30-year use restriction at 80% of AMI. That seems an awfully long time for already properties that are very old and are going to need either to being demolished eventually, et cetera, et cetera. So I'm just trying to figure out, is there a work around the fair market value? How is that decided? Let's say you can't afford it. Is there a magic number or a minimum that HUD's going to require for purchase?
Yeah, so it's a great question. I understand the dilemma here where you're trying to think about what is my short-term need or view and maybe what do I want to do more longer term.
Yeah.
In those types of situations, and I imagine there might be a lot of those types of situations out there, I'd encourage you to put together what you think is your desired outcome. So sketch it out, and it doesn't need to be too elaborate, but enough to be able to convey to someone what you're trying to do. So you know what you have today, and if what you want to do is do some modest rehab to a building, and you want to operate it as a mixed income building of some sort, you would sketch out like what level of rehab you think you're going to engage in. What income levels you're going to charge? Is market below 80% rent in your community? So is 80% some sort of constraint or not?
No, we can go higher.
You can go higher than 80. So then I would sketch all that out and then think about it from I think HUD's perspective would be what's the public benefit? How do you preserve that public benefit? And then talk to your field office and maybe talk to SAC. I think it's worth a conversation. What we're trying to do generally, and this is a good opportunity to make this point, what we're trying to do with this webinar and this whole series is give folks the benefit of great information that's kind of middle of the road. That is the information that relates to the more common situations that are out there. I imagine everyone on the call has a set of circumstances that are unusual and they could describe, and they really want to figure out what it's going to mean for their building and their portfolio. I'd encourage you to take the information in these webinars, use it to think more deeply about what you want to do, and then when you run into things that seem like you're not sure how that gets handled, engage with your field office, engage with the SAC, and they'll help you think through the very specifics. All the stuff is going to be situational, and what we're trying to give you is good knowledge to keep working it.
Okay, thank you.
Okay, I'm going to flip ahead to the slides again. Next couple of slides are going to take us back a little bit to some of the criteria around eligibility for Section 18. So all of this builds upon that last matrix that we thought about where we started with preserve or voucher out, and then RAD rents higher or lower than FMR, and then if RAD rents are lower, then we want to go Section 18. So now we're just going to review the eligibility for Section 18 to make sure that's fresh on folks' mind. Section 18 eligibility based upon PHA size or scattered sites. So again, scattered sites would be non-contiguous parcels of land which would have 4 or fewer units. on them. The small housing authority is 50 or less, and that's, again, that is at a point in time. It's not where you start. So if you have started with 1,000 units and you do a couple of RAD transactions and sell some scattered sites, and then you're down to a building which has 50 or less units in it, you could take that whole building through the Section 18, 50 or less. If your last building has 65 units in it, you could do the RAD Section 18, 50 or less, 50 of them going Section 18 with TPBs, 15 of them going RAD through the RAD process. So this idea of, if you're thinking about your whole portfolio, think about how you sequence things in order to optimize your available revenue is really important. So 50 or less is an option. And then we talked about SVC a lot. So it is an eligible path for housing authorities with 250 or less, but there's a lot of say that households have in determining how the vouchers will be used. That's eligibility for Section 18. Streamlined voluntary conversion, once again, so 250 or less. And it's a good option if you want to let your residents voucher out, or if you believe that you can secure consent from those households or enough of those households. And then to the extent to which folks wouldn't give you that authority, if you have your own housing choice voucher program and you want to preserve that building and you have an ability to backfill those units occupied by residents that did not provide consent, it could also be a good option. So again, I like streamlined voluntary conversion as a tool, and I think that it's a tool that is, you need to fit into a smaller box in order for that one really to work as a preservation tool. Couple of scenarios to amplify this. So here's 3 scenarios that relate to streamlined voluntary conversion. Scenario number 1, all or substantially all of the residents consent to allow the vouchers to be project-based. That's great. If my goal was to preserve my building and I had somewhere between 51 and 250 units in it in my portfolio, again, remember streamlined voluntary conversion is also comes with mandatory closeout, so it's my last building. So if I've got 51 to 250 units and all my residents consent, this is great. I can preserve my building and I can enter into a PBV contract following all the rules that we discussed in the first half of today's webinar. So it's a great preservation tool. And I can use that to borrow and recapitalize my building. Option number 2, some or few tenants consent to allow the PBV, and then tenants remain in the property with a tenant-based voucher. So the outcome here would be the property is filled with tenant-based voucher holders and potentially some units that have a PBV contract against them. So if I receive consent, the likelihood is that I use that consent to work towards a project-based voucher contract, and now a portion of my building has a project-based voucher contract. The other portion is occupied by residents who have a housing choice voucher who are living in that unit. So this option works if I want to keep my building. It's tricky for financing. So a bank is going to ask me a whole lot of questions about my revenue, and if all these voucher holders moved out, what rent could I receive for those? What would I do? And so my answer would either be I rent those units at a fixed dollar amount that I choose, that is either it's somewhere between market and what I think accomplishes my mission as a housing authority. So I choose a rent that I think I can rent those units at, and then people come and rent the unit from me and they pay all the rent out of their pocket. Or as they move out, I grow my project-based voucher contract with my available program cap in my housing choice voucher program to the point that the revenue for that building is not impacted. So there's two fundamental ways you can deal with these partial consent scenarios under SVC. Third option here, or third scenario, some or few tenants consent to PBV. Tenants leave property with tenant protection voucher. Well, I guess I kind of bled 2 into 3 with my explanation. But here you have folks that leave, and you have a choice of what you're going to do with that unit. So again, it's a good tool. It's a tool that you need to spend some time thinking through, really understanding what you think how your residents might react to this, and then playing out different scenarios depending upon those potential outcomes of the residents' decisions to see whether you have a feasible path to get to your desired outcome for your building. Capital sources. So again, think back to that barometer that we looked at before that had the green representing no rehab needs and red representing a lot of rehab needs. Depending upon where you fall in that continuum, you can secure funding sources. And these are some of the typical capital sources to reinvest in a building. First mortgage or debt. Could be an FHA loan, or it could be what's called your conventional debt, which would be an unsecured loan. Tax credit equity, 4%, 9%, historic credits, OZ money. There's a lot of folks that are still trying to figure out how to blend OZ money with low-income housing tax credit equity. It's getting there, but not as common as just a straight-on LIHTC deal. Public housing funds for RAD-only transactions, so you can use these public housing cash resources, or other available financing in your community. Could be block grant, home money, trust funds, anything that a city or state or county might have created over the last couple of years in response to the housing crisis. Okay, RAD versus Section 18 considerations. So when a property qualifies for Section 18, either obsolescence, scattered slate, or 50 or less, RAD might still make sense for you. So there's a couple of things to keep in mind as you're thinking about differences between RAD and Section 18. If the RAD rents are comparable or higher than PBVs, if they're comparable, I think there's, or if they're close. So the example that I showed earlier when I shared my screen and we looked at Oxnard, that wasn't close. I mean, 48% difference is a great distance. If they're, say, 5% apart, I think it's worth thinking through what are some of the procedural or process steps that are different between RAD and Section 18, and what do those mean for the Housing Authority. If your Housing Authority wants to use PBRA, RAD is the only path which allows you to achieve a PBRA contract. So there might be a couple of reasons that the Housing Authority thinks PBRA is the right reason. One of those reasons might be that the Housing Authority does not have a voucher program. They can't find a partner. So that might be a reason why PBRA is the preferred option. And if your Housing Authority has a large amount of public housing cap funds and operating reserves available that you would otherwise lose if you didn't have a place to spend them, RAD allows you to spend them. So that would take me back to my comparison of my RAD rents and my FMR rents. If my RAD rents and my FMR rents are close to each other, and I'm sitting on some very large public housing cash reserves, I would factor those cash reserves into my analysis to understand, you know, what is my real financial difference between RAD and a Section 18. And then there's some, if the Housing Authority wants to seek the RAD resident protection. So there's some of those differences we had talked about. Other considerations, what if the Housing Authority wants to transition a property to project-based vouchers but can't, but doesn't have a voucher program? So you find yourself a partner, another Housing Authority that you could partner with, or you go PBRA. And what if you are really at a loss? What if you've gone through all these matrix, you've revisited these webinars, you've read the notices, you've done some spreadsheets, and still really can't figure out what to do next, HUD has something called a repositioning panel. You can make a request of your field office to have a repositioning panel. These panels are phone calls that are scheduled weekly, so you would get on the agenda for one of them. And they bring together people from RECAP, from the Housing Choice Voucher Program, from SAC, from PIH generally, and you will have provided them some information about your situation. Folks on the call will have looked at it, and then you have a brainstorming session. You work with them to think about options. So it's HUD working with you to try to solve your specific issue and give you some guidance on how best to proceed. And then this last slide talks, this is new, so this last slide talks about this new aspect which hasn't maybe gotten as much attention as some of the others, but we want to make sure you keep this in mind. It's the RAD Section 18 closeout blend. So if you have a final property which has greater than 50 units in it, you can blend Section 18, 50 or less with RAD and get PPVs for the 50, and then RAD for anything beyond 50 if it is your final property. This will bring with it mandatory closeout, so keep that in mind when you're thinking about available cash reserves and things like that. But it is a great nuance to these available tools. Using a little graphic here that one size does not fit all. There's lots of combinations here. And a lot of the stuff is situational. It starts with what your desires are for your community, how you want to provide housing options for low-income people. It goes through what your existing real estate conditions are, what your funding flows from HUD look like, and factors in what you want your organization to look like in the future. You consider all of that, and you come up with what is your best judgment about an optimal strategy for your housing authority. Last slide before we get into a final knowledge check. This slide again points to a couple of pretty critical notices. We mentioned these throughout the day. They're listed here as a way to give you another reference, and they're also curated on the Repositioning website that HUD created. It brings all this stuff together in one spot in a very useful way. All right, I'm going to take us quickly through these last couple of knowledge checks and then open it up for questions. True or false? Public housing property can be sold if approved by HUD, and proceeds can be used to support a RAD, rehab, or redevelopment. That is true. So RAD has that unique characteristic where while being a Section 8 property, it can benefit from Section 9 expenditures. Let's skip ahead here. Oh, apologize. If a housing authority wants to combine RAD in Section 18, 50 and under, they should start by submitting a RAD application that covers all the remaining units. So this particular tool or combination of tools is facilitated through the RAD interface. So you submit a RAD application, you get a CHAP, you go through the process of working with a transaction manager, you have a concept call. At the concept call, you'll then talk with them about how you're going to blend 50 or less with your CHAP and execute a single conversion for your last property. Apologies. True or false? Better have paid a lot of attention to this decision tree because you're on your own after this. The answer to that one's false. Your local field office, SAC, the repositioning panels, information available on the resource desk is all information that's still available to you. HUD is making a concerted effort to put a lot of information out there to help folks understand these rules and understand the best how to think about strategy. So you are by no means on your own. All right, so this is our last slide. And Christine, I think now is the time where we can open it up to questions from folks from the Housing Authority that they might have for folks with RECAP or folks from the SAC or the Section 8 program or in a field office representation generally that are on the call. Do we have any questions?
Not seeing any questions yet. You are starting to break up, Mike. I don't know if there's anything on your end that's changed since it started.
Thank you for letting me know that. No, nothing did change, but is this better? Can you hear me better?
Not really. We can sort of hear you, but it's just kind of in and out and a little bit choppy.
My apologies. Looks like we have, I can see a question or a hand that went up. From the okay.
Did you see Jeff again?
Jeff, yes.
I'll unmute the line. I'm not sure if that was a hand raised from the earlier question.
Jeff, do you have a question for anyone?
The line is unmuted.
Maybe we answered Jeff's question. Not seeing any other hands raised, and I'm not seeing anything in the chat room. Looks like maybe we have a question from Michael Benning. Christina, how's my audio? Can you hear me?
I can hear you, yes. I am unmuting Mike Benning. You're unmuted, Michael.
Michael, do you have a question for anyone on the call? All right, maybe that was an inadvertent hand raise from Michael. Okay. Doesn't look like there's any other questions at this point. Our next webinar will be on Thursday, same time. Topics for next Thursday are public housing closeout process, and then coming back to the case study. So we'll try to bring some of this information together and do a little screen sharing and walk through again some of the scenarios. Encourage folks to spend some time doing some of these similar tasks for your own portfolio. Access that information that we pointed to on today's webinar. We will type up questions that were asked or finish typing up the questions that were asked following or during our last session and send those out to the folks that had them. And you know, if something comes to you and you want to save it for Thursday, feel free to ask any questions Thursday about anything having to do with content from these first 3 sessions. Thursday we'll try to wrap all this together and and leave you with hopefully a good foundation, a good information about where to go to keep doing some of this work for yourselves. Today we can wrap up. Christine, anything else from your side?
We actually, Michael was able to type his question in, so we can see that during this time. It says, when a family becomes overhoused after a child graduates high school, does the family have to move out of the unit?
So if they are overhoused, do they have to move out? So Ava, is this a question you want to take on?
So we're assuming this is project-based voucher, right? So families cannot occupy a wrong size unit under the project-based voucher program. And that is explained in 24 CFR 983.260. And if the family changes size so that it's occupying a wrong size unit in accordance with the PHA's subsidy standards, then the PHA must offer the family the opportunity to receive continued housing assistance in another unit. And then the family would be afforded some time to move.
Thank you. Michael, I'm glad we got your question in there. Okay, I think we can wrap up. I just heard that. Was that another question?
Nope, I didn't see anything else come in. I think we can wrap up.
Okay. Thank you very much, everyone. Appreciate your time today and look forward to being with you again on Thursday.
Thank you for joining, everyone.